Hi, I'm Bill Wilt of Assured Research. Thanks so much for joining this quick hit video where we're going to look at one research note drawn from our May 2025 Assured briefing. If you're a subscriber, thanks for joining this, and we hope it supplements your understanding and your interest in our work. If you're not a subscriber, again, hope you enjoy it, get some value from this. Feel free to poke around the YouTube site, LinkedIn posts. And if you're so inclined, reach out to for a trial. We'd be happy to add your company to one. In this note, we're going to focus on the yield curve and specifically the risk that the yield curve could invert if indeed the country does start to experience enough of an economic slowdown that we near or are at risk of going into a recession. Not forecasting that. It's obviously being talked about in the context of the tariffs and the economic pause so many businesses are feeling. So we wanted to look back over history and ask the question: how does property casualty insurance investment income perform in the face of an inverted yield curve? I'm going to pull up the slides because here pictures are truly worth a lot of words. Okay, good. Let me do here and share, and there you go. So, this, I think, it's probably a full-blown class to talk about the structure, the term structure of interest rates. Allow me to just observe and share that typically the term structure is positive. So longer dated securities offer a higher embedded annual interest rate than the shorter term securities. Risk premium, liquidity preference are two of the theories, just kind of general, the general sense that if you're going to lock up your money for a longer period of time, you want to be compensated more than if you're locking it up for a shorter period of time. I guess that would be the liquidity preference theory. But what's happened over decades is that the yield curve oftentimes inverts before a recession. It can invert for a number of reasons. The easiest to kind of explain and understand is that if investors anticipate that the economy is going to enter a slowdown, then they're also going to anticipate that the Fed may at some future point cut interest rates, and therefore the longer dated securities can actually dip below the annual yield on the nearer dated securities. So the 10-year minus the 2-year is a good, it's kind of the standard measure of the yield spread. And what you see with the arrows here is that yield spread has typically gone negative in the quarters, a few quarters before the U.S. has tipped into a recession. Now, that wasn't the case. The yield curve was inverted for a year or more recently. We obviously haven't had a recession, so it doesn't always work. And you can see that this data probably takes us through mid-April, third week in April. The yield curve was still positive, even though lots of folks are starting to talk about the risk of a recession. So it's not a perfect predictor. I know that in the current time presently there's some talk of technical factors, kind of global international flows and investments in the context of the trade disputes that are going on. So again, we're not going to get into that. Just observe that the yield curve does oftentimes invert ahead of a recession. The question is, what happens to insurers' investment income when that happens? So what we did was to look back through the early 1970s at the industry's results, property casualty industry's results in relation to the yield spread. And if you look in the graph on the left, I guess and we go, let's look at the column on the far right-hand side, the yield spread column. Very little relationship, no meaningful statistical relationship with the combined ratio, nor with net written premium growth. And that, I think, is broadly consistent with the observation that the P&C industry is recession resilient, not recession proof, but recession resilient. Combined ratio tends not to be meaningfully impacted by the absence or presence of a recession. Likewise, investment income growth isn't so meaningfully impacted because we enjoy a relatively inelastic demand curve. Not recession proof, but recession resilient. But look at the jump at negative 49.1%. So a meaningful inverse correlation between the yield spread and net investment income growth. That's also drawn out on the right-hand side where we look at it as the yield spread widens, so that term structure becomes more typical, positive. Investment income tends to go down, but when the yield spread narrows or even inverts, the investment income tends to grow. Now, admittedly, I puzzle over that for a period of time. It's not screamingly obvious why that happens. But I guess if you think about the nature of property casualty insurance, we almost always enjoy positive cash flows. So if the yield curve is inverting and the short end of the curve is rising, insurers can actively manage their portfolio, shorten their durations is reason one. Reason two is because we're cash flow positive, they can invest money, keep it short and really benefit from the rise in the short end of the yield curve. So I think those are probably two of the reasons, and I suspect a shift in the curve matters more, at least in the immediate term, than does some wiggles in the shape of the yield curve. Some of the reasons for that, but nevertheless, the relationship is fairly strong, and it would suggest that if we do experience in 2025 an inverted curve, that we could still enjoy some reasonably strong, robust net investment income growth. What's shown here is the smooth trend over time. Not surprisingly, through the 80s, the 90s, interest rates were coming down, so investment income growth was slowing. It was really flattish and low during, after the great financial crisis, and it only recently really started to rise again. The predicted point there for 2025 isn't a forecast per se, but it's just saying if the yield curve stayed or became inverted in 2025, much like it was in 2024, which was just barely inverted, we could still, as an industry, enjoy over 10%, between 10 and 15% net growth in net investment income. So add this, I guess, is the bottom line to what's pretty well understood to be the economic resiliency of property casualty insurance. Net written premium growth not meaningfully impacted because of an inelastic demand. Combined ratio, history shows, not meaningfully impacted by a recession. And here we have yet another positive and defensive attribute in that net investment income can still grow in the face of an inverted yield curve, which often accompanies a recession. So there you have it. More in the note. I kind of glossed over some nuances that are certainly important here. And again, I would highlight that I think the industry is recession resilient, not recession proof. But I do hope you enjoyed that, and it'll be our pleasure, as I say, if you're not a subscriber, to put you on a trial if you're so inclined. Thanks again. Have a great rest of your day.